Hello, everybody. So, I've been doing these videos about the economy and housing prices and car prices and inflation and all kinds of other stuff for 6 weeks. Um, and basically, what I'm doing is going through government data and saying, okay, let's just kind of look at it and try to figure out what it means. And as I go through that process, sometimes I look at data that has meaning. Sometimes I look at data and I'm like, okay, that doesn't really help me try to figure out what's actually the underlying problem here. But today I came across a couple and I'm like, okay, I'm going to do another video. But I thought instead of just doing that video, I thought I would just do a live version of the research process, because one of the things I like to do with this channel is try to tell people, look, use your brain, right? Think for yourself and do data analysis and kind of look for what you think might be the right answer, but don't depend on other people to spoon feed it to you. And I think as a society, we do way too much of that, letting other people spoon feed us, because then there's always a slant. I remember I hear things every once in a while that there used to be this thing called an impartial news organization in the United States. I'm not sure I believe it. That might be a fairy tale. But I hear there was one. But the interesting bit about doing some of this research is that you get to you get to actually kind of figure out things for yourself, and it's fun to kind of look at the same data sources that various news organizations are looking at and saying, okay, what does this really mean to me? Is this sort of what they're telling me true? Right? We need to be able to make those sort of conclusions for ourselves. And I thought, instead of doing a bunch of analysis and then spoon feeding it, I thought I'd do some analysis live. And if you want to ask questions, feel free. I think the only place you can ask questions is on the YouTube side. If you see me on Twitter, you might have to go to YouTube to ask a question where I see it. I don't always see it when it comes through on Twitter. But if you're on YouTube, you can ask in the chat window and it pops up in front of me. So without further ado, let's look at some data. And first, I think it's important to look at what started me down this pathway today, because this is actually part of these numbers are things I've looked at before, but I think they've kind of gotten worse. So I wanted to kind of dig into them again and see where things have gone. Mostly I'm looking at the housing market. And I saw this show up over on Twitter, and I had to call a couple of real estate agents, and I'm like, is this really happening? Is this kind of stuff real again? And it came through because I follow Amy Nixon, who is a reporter and not known for slant. She does check her sources. She does check things out, and she's very in tune with the real estate market. So I was like, okay, I kind of trust it, but anybody, when you get to my age, I'm 52, 20 real estate agents. So I called a couple and I was like, is this really what's going on? They're like, oh yeah, this kind of stuff is happening. So what this says is, this is the description of a home that is for sale right now in this market. It basically says, hey, look, no showings without a contract, which means, and translates to, you can't go look at this home until you've made an offer and I've agreed to your price and we're under contract, which means you have to buy it or it costs you money to get out of that contract. By the way, it's an investment property subject to a 12-month lease. The current rent amount is $2,750. That lease is over on 9/30/2024. Doesn't mean the renter is going to leave. It just means that, the rent is the lease is over on 9/30/2024. Also doesn't tell you if the renter's any good or not, right? Are they current? Are they behind? You always have to, dig into them to go get paid as a landlord. Those are important things to know. The seller's price is increasing. The selling price will have to be raised. I'm sorry. Let's go back a step. Due to seller's debt, the seller needs a minimum of full asking price to consider. So if you don't offer every penny they're asking, you're not getting this house. Interesting. As the seller's debt is increasing, this can be interpreted a couple of ways. The selling price will have to be raised accordingly. So if the seller's debt is increasing, that means they're not making their mortgage payments, because the only way the debt on a home can increase is if you're actively taking out loans on it. And if you're selling it, that's a bad thing. But if the seller's debt is increasing, they're not making payments. That's what that translates to. Please do not call to ask if circumstances have changed. The seller has no funds to come to closing. Sorry for inflexibility, which means they're underwater, right? So they are actually in a position where they owe more than the house. They owe more than they think they can get for the house. So this is a big warning that says, thou shalt bring every penny that we've been asking for, and it's going to get worse from here. Still, there's no funds to come to closing. Sorry for inflexibility. Agent is a CTM user. All information is deemed reliable, but not guaranteed. Buyer to verify. So that means I don't really trust my person. Title will be transferred via special warranty deed. I'm not exactly sure what that is, but we'll figure it out. Supply proof of funds, pre-approval letter, blah, blah, blah. So what that means to me is that this home is a fire sale, right? This is one of those ones that's like, hey, this is a big problem. So I live in the Dallas Metroplex area. I live north of Dallas, a town called Frisco. So I called a couple of agents that I know because they're all over the place. And I said, is this normal? I was like, well, we used to see it back in 2008 and 2009 a lot, but we haven't seen it recently. But yeah, we're seeing more and more of it these days. Really? Seeing more and more of it these days. And I was like, really, just on homes that are rented? They're like, no, not just on homes that are rented. It's happening more and more. They didn't say it's happening a lot, but it's becoming more frequent, which to me says a bad thing about the housing market. So let's go look at some housing market data. And this is how I do research for these videos, partially because I like actually researching things I talk about. I don't like to just go off and say, oh, look, here's the answer. No, I actually like to dig into it and figure out what the real deal is, as they say. So let me put another pile of data up here on the screen for you. So this, I've shown this off a couple of times. This is the average sale price of a home sold in the United States. The average. So that's New York, LA, all of it's lumped in here, but so is Waco, Texas, Cramples Gap, Podunk, Nowhere, Kentucky. These are the flat out averages. And right now, Q2 2024, the average home sold in the United States is $501,700. That's not the important part of this chart. If you look at it from the 1960s on forward, there was a gradual increase with a few little rapid rises that occurred late 80s, early, sort of in the 1980s, right around here. Then we sort of increased, but not incredibly. Right around here, sort of after 9/11. This is 9/11, War on Terror. We went a little bit faster, then home prices came down. That's the 2008 crash. Okay, this is since 2008. This little bar right here is COVID, but look, we kind of went crazy over here, and since COVID, we've been off to the races, except for this last since Q2 2022. So that right there is Q2 2022, where it seems to have sort of peaked and leveled off. Hasn't really changed much since then. It's gone from 525 average down to 501. So, it's come down a bit on average, but not a huge amount. Now, that flat part right there coincides with them raising federal lending rates. So when the Federal Reserve raised rates, what happened right there is mortgage rates went up. Well, the house prices stopped going up when mortgage rates went up from 2 point something up to sort of 5, 6, 7%. Well, gee, if I'm paying twice as much interest, yeah, of course the house price, I'm not going to buy as expensive a house because I can't afford the payment on it, right? So I don't do that. So I went and looked at a few other things. Now, if you go back to 2008, and the 2008 crisis was called by these things called collateralized debt obligations. And those CDOs were the thing that damn near pulled down the entire U.S. economy. Those ththings were based on mortgage bonds being sort of bundled and sold off to other banks. So you bundle the mortgage bonds, you go off and sell them to another bank, your world is a wonderful place. You're the banker, you make a lot of money, right? So let's go off and look at a few mortgage funds, and you go off and see like this one, the American Fund Mortgage C. This is one mortgage bond that you can go off and buy. It's a fund that basically invests in mortgage bonds. And I looked at it and I was like, last cap gain was minus 14. That's pretty big. Your yield is 3.5 on a bond. That's okay. But 80% of the fund's assets are invested in mortgage-related securities. Those bonds that were part of the CDO crisis. Now, the CDO wasn't the bonds themselves. The CDO was sort of people wrapping those bonds up and selling them off and then doing these things called uh, swaps on collateralized debt obligations, all kinds of other things. But um, if you look right here, this Morningstar rating, the risk rating is above average. So it's above average on a mortgage bond. So that to me was like, what the heck? So I went and looked at it and I was like, okay, let's go look at the holdings. And this is all stuff you can pull off Yahoo Finance. So they've got 99% of their money in AAA rated mortgage bonds. Those are the sort of creme de la creme of mortgage bonds. And the other 9% of their bonds are in federal government bonds. So 98% of their money is sitting in bonds, most of it tied up in between AAA and government bonds. And the worst they've got is I don't know what other is. I haven't been able to figure that out, but it's such a small number. It's less than 0.5%. I'm not going to worry about that. But 99% of the bonds that they own are. I'm sorry. So look at that. Your bond rating 99. This one's 9. You got 98% of your money in bonds. You got a big problem here, right? So if you look at this summary, Morningstar's rating them below average, and I went, well, that's really weird. So let's go look at another bond fund that I pulled up, another mortgage bond fund. So they got a 4-star. It's still above average risk. And if you go look at its holdings, they're basically in the same thing. They're in government bonds and AAA rated bonds. And it's sort of the same profile as the other one. But if you go look, this one gets a Morningstar rating of 2. This one gets a Morningstar rating of 4 stars, which means it's a little less risky, right? So it sort of makes no sense how these two different things have different ratings. But again, you've got cap gains going. So it's weird. So I started looking at some other things, and I went through and I just started looking at. Let's go off and try to find some other mortgage news. BlackRock. Let's look at BlackRock. Everybody likes to talk about them, right? Mortgage. No, that's not the right one. Let's find another one here just for fun. Well, everybody is. All right, so here's another federal financial mortgage organization, right? So they're kind of not looking that great. Let's look at their 3-month chart. Their year-to-date chart. So year-to-date, they've kind of been flat, but the best they've ever been is up here. Not doing all that great. But these bond funds are what has me kind of concerned. The bond funds themselves are what backs everything up. Now let's look back over here and say mortgage rate. So here's your percent that we're paying on our mortgage. So this is your 30-year fixed rate on your mortgage, right? So back here in 1971, you would have paid about 7%. In the 1980s, it would have been about 18%. Now let's look at what was going on right then in the world, right, or in the economy. So right around here, you had massive inflation going on. So those federal funds rates were really high. The Fed rate was up. So that, of course, forces that number to go up. And what that does, what the federal funds rate does, is it controls sort of the rate of your mortgage. It controls rates at which banks borrow money from each other. But it also pulls money back out of the economy to slow down inflation. So it does serve a purpose. So remember a couple of years ago when the price of eggs went through the roof and lumber was through the roof and everything was expensive. Well, the federal funds rate was very low. So the way they got around that over here is they raise that rate. So the higher you raise that rate, the more you control inflation. It does bring the Dow down. Typically, it does bring, as you raise rates, the Dow comes down, housing mortgage rates go up, car loan rates go up, credit card rates go up, all that goes up. So they made it pretty low for a pretty long time. And then over here, it went up. So let's go look at that federal funds rate. I don't think I can find it on the St. Louis Fed. I think we have to go through another group for that. Federal funds rate over time. Oh, same one. All right. So here it is. Here's the actual federal funds rate. So in the 50s, it was 1%. This is the percent by which banks borrow money. Then in the 80s, you see it spiked. It was way up here. Well, so did the mortgage rates. Well, over here, banks were borrowing money at 0.07%. So if you're a hedge fund or if you're a mutual fund or if you're a big bank and you want to go off and loan a lot of money to mortgages or car loans or whatever, you could take more risk because you're borrowing that money at 0.07%. You're loaning it out at 3 or 4%. You say, okay, well, maybe I'll loan it out at 7% and take a bigger risk and loan it to somebody who might not qualify. Well, when you're paying 0.07% for that loan, you'll take big risks. Now they're paying 5.3, so they're not going to take as big a risk. So if you look at those numbers, that kind of drives all this other stuff. But when you go back and look at these mortgage funds, it doesn't make any sense why they would be called this risky. Then I went back and did a little more research, and this is the one I'm still following up on, and I can't find numbers on it yet. I'm still looking. Remember back in 2008, there were these things called the collateralized debt obligation, or CDO, that kind of killed the housing industry. It kind of destroyed it because the banks were out there, or big investors were out there taking bets, and sooner or later, more and more risky loans were being put in place. And the reason those CDOs were a good thing is if you packaged one up as a banker and sold it up, you got a nice commission check. It was really, you're joining a country club, you're buying a boat, you're doing all kinds of stuff. Now those were kind of wiped out after 2008. We passed a bunch of laws that said no more, CDO can't happen. Well, they've kind of renamed it and changed a few things, and now it's called a bespoke tranche something or other. So it's like they kind of changed the name of it, but it's essentially CDO under a different name. It's not as big as it once was. You're not seeing as many adjustable rate mortgages as you did, but what you are seeing, at least not to the same quantity, but I think you have seen just as many speculators inside real estate. Now, this is another interesting point, was a lot of those speculators went off and put money into things like, let's buy a whole bunch of houses and turn them into Airbnb. Because, after COVID, we all wanted to go on vacation, and well, who wants to stay at a hotel with all those yucky people who might be sick? Well, Airbnb over the last week announced its quarterly earnings. Now, that did not go terribly well for them because people have stopped staying at Airbnbs. So let's go take a look at what Airbnb did or didn't do on the stock market. Well, there it is. There's their last 3 months. They're down 27% in 3 months, but really most of that's in sort of the last week or so. So here's where they reported their quarterly earnings. And man, it went from $130 down to $115 kind of overnight. It hasn't really recovered since then. Not that I think it should, because I think that business model is what's driven a whole lot of speculation in the housing market. And it's caused people to kind of get into buying more of these places and renting it out. And the Airbnb charges are now high enough. It's just cheaper to stay in a hotel. So what's happening is homeowners are buying these Airbnb homes, renting them out for a weekend, what it will cost them to make the mortgage payment, just hoping for the best. But this is the other interesting one, is if you look at, come on, computer, stop that. Airbnb vacancy rates, what you're starting to see is people out here complaining and talking about, those vacancy rates, occupation rates are 70%. Well, they used to be a lot higher than that. Right. So now you've got some Airbnb owners kind of complaining that, well, gee, my Airbnb's been empty for weeks, right? I haven't been able to get anybody in there. So you can go look it up in this website called All the Rooms. You can actually look by city, occupancy rate in 2020, 2024. It went up for those 2 years. But if you look more recently, it's coming back down. That's just the 2021 chart. Let's go see if we can find the more recent numbers. 2024. But now they're saying the good occupancy rate is above 65. Well, some cities you'll see people complaining that it's actually lower than that, which is not good if you're the owner. So if you've got a place sitting empty and you owe money on it, you owe a mortgage on it, you wind up with things like this guy right back here that we used to start this entire conversation, where, here it is. Oh, it's occupied. I can't afford it. I'm not paying my bills. This is getting more expensive. I don't know that we're in for a housing crash the same way we had in 2008, but I do think we are in for a big problem. And here's why. Mostly because of, if you go look at this video I did a number of weeks ago, say hi to ourselves, by the way, everybody. playlists. I went and did a video a while back in here. We don't need to listen to me twice about the housing bubble, about the housing market. So here we go. So what I did with this chart was I said, okay, let's convert everything to a common year dollar. Okay, so I converted it to the most recent year dollar. But this is average income in the United States. This is average home price in the United States. And if you look at that over here, you could buy the average home for 1.3 times the average income in the United States. Over here, to buy the average home in the United States, you've got to spend 11.3 times the average income. That's a big difference, right? So you go from 1.3 to 11.3. Well, it's no wonder we had families where one person worked and one person stayed home with the kids, or we had, everybody owned a home and they didn't necessarily have the office job or the six-figure job and work in finance and have a trust fund. Well, it's because, you've got these numbers are much closer. This is much more rational. Over here, it's insane, right? It's gotten too expensive. So trying to buy your first home becomes a real problem. And when we go back to looking at things like this popping back up in our world where, hey, I'm not making my mortgage payments. It's getting worse. I'm going to owe more money, so my price is going to go up. That's a problem, right? I think we're in for a crash, and I think it's going to hurt. I think it's going to be bad. The trouble is this time, unlike 2008, what you've got is automation and AI are coming online much faster than ever before because I work in AI. Not generative AI. I don't make artwork. I don't make, we're not competing with OpenAI and their stuff. It's a whole different world. I work in predictive analytics, which is basically analyzing messy piles of data and trying to figure out where it's going to go, which 10 years ago would not have been called AI. It would have been called funky math with data. But the point is that I work in those fields and I know people who work in automation. It's getting a lot cheaper than it ever was. So as labor costs go up, people are looking at how do you replace it with AI, and even Dell, 24 AI. So Dell announced a whole bunch of layoffs this week because laying off 12,500 employees because they're basically replacing them with AI bots, right? So you've got AI coming online, you've got automation coming online, you've got the housing market about to fall apart, and you've got a point where inflation was so high they had to raise rates. Well, now to fix the market and to fix the housing market and the stock market, what they're probably going to have to do, and both markets are expecting it, they're going to have to lower rates. The trouble is, for most people, that means inflation comes back, and we can't necessarily afford that, right? So if you throw all that in a pile, I think that's what one of our presidential candidates was talking about by saying, oh, we could have a 1920s level depression. The situation seems primed where that is possible, with one difference. In 1921, we didn't have the Federal Reserve, and they couldn't just print money because we were on the gold standard. We're not on the gold standard anymore. So the same presidential candidate, and I don't want to say their name because I don't want to get into politics because that's a whole different video. But the point is that that same candidate said that, the president should be able to help set interest rates. Well, he wants to do that. Okay, I just let out who it was. They want to do that because then they can get involved in figuring out how to make sure the Dow stays up and mortgage rates stay down. So you artificially are propping up those two markets when you keep that cheap. The trouble is the grocery store prices, the dentist prices, the insurance prices, all that gets higher and higher and higher, more out of reach of more people every time you raise those, for every time inflation kind of hits. And we haven't recovered from the years of inflation, the 2 years of rampant inflation that we had. Inflation has finally come down to about 3%. It's sitting around 3 to 4 someplace. The trouble is everybody's income is only increasing at 3 to 4% a year. And when you had a couple of years where it was increasing at 10 to 12, you see the difference, right? So we haven't caught up to all those inflation years yet. And what we're making is still not caught up to where we were just 2-3 years ago. So if you throw all that in a pile, I don't see how the market or the economy doesn't take a kidney punch. And I really don't see how the housing market gets through this without, if my math is right, something like a 25% correction in the next 12 months. I just don't see it. And the big question is, and this is the one I see kind of showing up in all the sort of weird scuttlebutt on different websites, is, will it be before or after the election? And when it comes to the economy, I don't know about you, but I really don't give a shit. I don't care if it's before or after an election to help one party or another out if it's the economy. That's about, family's future, your family, my family, and everybody else's being able to plan for something. And I don't care which party gets credit for fixing the shit. Just fix it, right? And if it really is going to make the difference in between, we have to pick whether or not it's people who inflation really hurts, or whether or not it's people in the stock market and the housing market that get to win. I don't think we need to pick winners and losers anymore. We've done enough of that, right? And that's what I kind of fear is going to happen, is one of those two parties is, or maybe both, is going to go off and try to pick the winner. So I'm still working on this data, and some of this probably didn't make sense because this is me sort of thinking out loud as I try to put these thoughts together for another video. But when I saw, the announcement that, we could slide back into a, depression level economic situation, I was like, no, we can't. Where the hell is that coming from? And then I started seeing this stuff, and I'm like, okay, I can see where you can make that argument. And then at the same time say, we can slide back into a depression. But then also, hey, give me control over the Federal Reserve and I'll make sure that doesn't happen. Well, of course, because you're going to make the Dow look good. You're going to make the housing market look good. And you point to those and say, oh, look, victory, right? But that doesn't really impact the way people live their day-to-day lives. Because I was reading someplace that a large number of people, it was a double-digit percentage, can't afford back-to-school shopping this year, which is my kids start school next week. I mean, I can afford back-to-school shopping, but it's if a large growing number of people can't, that's a big problem. Because it does matter, right? You don't want to send, my kids are in middle school and high school. You don't want to send them in there, because middle and high school, it's pressure years for kids. You want to kind of make sure that they're kind of on the best foot, so they're not dealing with any more social pressures than they already are. And if people can't afford that, it's bad. So I don't know where we're going. I don't know what's going to happen next, but I can tell you that I think either one of two things has to happen. Either they have to lower rates, which will cause inflation to come back to sort of those double-digit percentages where rent was going up, 5, 6, 8, 10, 12%, depending on where you lived. Mortgage prices were going through, or house prices were going through the roof. So even though the interest rate on your mortgage was low, the price you have to pay for the house is high. It's one way or the other. It's an inflated value. I don't see how we get out of this without a 20-30% correction on housing prices in the stock market. And I don't see how we get out of it without at least some more inflation rearing its head. But if I were in charge for a day, I would say, okay, look, we're not going to completely exonerate one group or another. We kind of have to spread that pain out because we have to come out of this as quickly as we can and say, how do we fix it? And the more and more I look at this data, the more and more I realize I don't think us being this broken is a new invention. I think this dates back to about the 1970s, because as I analyze the data, I can find sort of signals in the noise that say this sort of started when we came off the gold standard. And it kind of got worse right around the war on terror, not too much worse, but a little bit worse. And then 2008 just about killed it, right? And then all the indicators for what we're seeing today were all there. And then they kind of slapped a Band-Aid on 2008 and they bailed out the banks. Great, good for them. The banks didn't go under, but a bunch of homeowners did. And the homeowners have never really recovered. So people who got killed in the 2008 crisis, I don't think ever really bounced back to even remotely close to where they were, which was an artificial spot anyway. But to me, I think you really have to figure out how to say, okay, look, the stock market's at all-time record highs, the housing market's at all-time record highs, expenses for individuals are all-time record highs. That's another bit of data that I found interesting that we can show off here for a second. And it's difficult for me to type and talk at the same time, so you'll have to bear with me a second. Total credit card debt in the USA hits a record. Yeah, so total credit card debt in the United States has hit a record high, and that's just recently. And what they've done is various groups, and you can go off and read these articles for yourself, but right now, total credit card debt in the United States is $1.14 trillion. So some of those cardholders do pay it in full every month. I'm one of those people. But the carry is also big, and people aren't putting nice to haves. People aren't putting vacations on credit cards and not paying it off. What's happening is people are putting more and more day-to-day expenses, more and more medical expenses, more and more, gotta haves, not nice to haves kind of stuff on credit cards. And that's what's driving that number. And that's not me talking, that was Experian. So, somebody asked me how big the hit's going to be in both the stock market and the housing market, and I don't see how we get out of this without 20 or 30% in both places. I just don't see it. What's the right answer? I have no idea. And if somebody says crypto, I will laugh because I am the world's last person you would ever convince that crypto is a good idea. But mostly because I understand math. But I don't know. It's going to get ugly. So that's all I had today. I hope everybody's having a great weekend. And thanks for stopping in. Bye.